guys, Dan MacArthur here with Vibe Realty in Abbotsford, BC. Here today to do another video for you. Today we're going to look at a mortgage analysis. So I'm going to take you through all the different moving parts in a mortgage. So looking at what a purchase price is, your down payment, your principal, how we're actually paying that off over the course of the mortgage. We'll look at how interest rates affect how much principal you're actually paying down and how much interest you're paying every month. We're also going to tie in CMHC or mortgage insurance and talk about how that affects your payment, how CMHC works, and then we'll talk about that new stress test that you've heard about in the media, just how that affects how much you can actually finance and what specifically they're looking at when they're looking at this stress test. It's actually pretty simple, and we'll go through it right now. So I'm going to do this all in Excel. I love Excel. I'm a nerd for Excel. So I'm gonna kind of show you how I put this spreadsheet together, and then we'll kind of go through how changing different aspects of the actual spreadsheet itself makes a dramatic change to how much you're paying every month, all that sort of stuff. So let's start right here. We'll just start in the top left-hand corner, and we'll look at purchase price. So let's pretend the list price was $404,000, and you purchased this property for $400,000. You have $50,000 to put down. That means you have a principal balance paying off of your mortgage of $350,000. So the amortization period, or how long you're taking to pay that mortgage, we're going to call it 25 years, and you make 12 payments per year, monthly, of course. So you're looking at 300 payments for the life of this mortgage. Let's pretend the interest rate is 2.7. That's roughly what the bank rate is, and this leaves us with a debt service of $1,605.64. That would be your debt service or your mortgage payment. So I calculate that mortgage payment with a fairly basic function in Excel, the payment function. So going through some other numbers, we'll look at some other numbers as well. We'll look at CMHC. So in this case, with $50,000 down, we're coming in at 12%. Okay, so 12.5% is what we're putting down on the property. That puts us at a CMHC premium of 2.4%. So this crazy if statement here is just referencing these cells here, and that gives us this CMHC premium of $8,400 that we can write off over the course of the mortgage. So we're looking at a payment of roughly $38.54. Let's pretend the strata is $300 and property tax is $1,654. So our total monthly fee on this is $2,000.43. Let's talk about that new stress test now, because a lot of people ask about it. What does it mean? So we'll tie that all in with this little bit of qualifying income analysis here. Okay. The first thing I want to talk about is the gross debt service ratio. Now, that's a really fancy way of saying that the banks don't want you to spend more than 1/3 of your income on your house every month. That's what all the gross debt service ratio means. So some banks it might be 0.28, some banks it might be 0.32, 0.33. I mean, it varies based on the financial institution, but that's what we're looking at. So this is the gross debt service ratio. So right now, because we have less than 20% down, they're using a new interest rate to develop or to define our payments. Okay, so the test rate they're using is 4.64%. Now that's going to change our monthly payment fairly dramatically, or how much that $350,000 that we're paying off over 25 years originally cost us $1,600 a month, and now it's going up to $1,973 a month, which affects our total monthly payment and brings that up to $2,400 a month. So our total monthly required, if that's only going to represent 1/3 of our income, you just divide this by 0.33, and that's going to give you the amount of money you're going to need to make to finance this purchase. So your take home under this scenario is going to have to be $86,000 or $43,400 per person. That's effectively how this qualifying income or the stress test works, is they want to see if your income can actually support this purchase if interest rates were to go up to that 4.64 mark. That's what they're testing you at. Now, if you come in with, let's say, we'll bump this up to $80,000 or $90,000. Make sure that we're over. So we're at 22% now. Now they're not using that stress test anymore. So they're not going to actually. They're going to keep you at the bank rate when they analyze your income. So it just gives you some, I guess, context as to how they're using that 4.64% when they're testing whether or not you can finance a mortgage. Let's go back to the previous condition. So we had $50,000 down, and that drops us down to 12.5%. So we're making this payment of $1,600 a month. Of that, $818 is principal. So what does principal mean? That's just the amount of equity you're building in the home every month, and it will go up over time as you pay down the debt itself. Of that $1,600, you're paying $787 of interest. So if you look over here, if we look at equity, after year one, you will have built just short of $10,000 of equity in this specific property. So we can scroll through this schedule and see very simply, see how our principal is going up and our interest rates our interest is going down. So over time, we pay more and more in principal and less in interest and build more and more equity. The same is happening with your CMHC premium. Over time, you pay more and more in the principal and less in interest. Right, see here, we're at the last payment, we're at $38, and we're only paying 9 cents in interest. Here we're paying almost a full $1,600, and we're only paying $3 in interest. So that's how these mortgages work and how they get written off over time, and then eventually zero out in terms of our balance. So now if we play with different rates, we can see what a mortgage would look like if, let's say, the interest rates went up to 3.5%. How does that affect our payment? How does that affect the amount of interest we're paying? So you can see right away, our principal that we're writing off goes down. Interest goes up, and the same is true in CMHC. So you can play with different rates and sort of get a sense of what what you're going to have to prepare for if rates do go up, and what that debt service is going to look like. So if we go from 2.7 to 3.8, so look at that real quickly. There's almost over $100 change there just by going up, not even a full percentage point. We can play with purchase price. So let's say, you're really, if you're analyzing a purchase, let's say that your purchase is $405,000. How does that change? Let's say that we want to grind them on that last $5,000. What does that change in our monthly payment? Well, it only changes at about $22. So is that worth losing the property over $5,000? It's totally up to you, but you can get a quick sense of what, if it's $410,000, how does that, at what point does it make a palpable change in our monthly payment? And that's something to sort of be mindful of when you're negotiating. So we'll go back to $400,000, and we'll play with interest rates again. So if we can get 2.7%, what if there's an offering for 2.4%? That drops our payment quite substantially. So looking at these little numbers, 2.6%. So you gotta, not only do you have to grind the sellers when you're buying, you should also be really shopping for that best interest rate, because that's also ultimately going to save you money as well. Well, guys, this was just a brief overview of a mortgage analysis. I hope you found some value in this video. If you want a copy of this template, I'm more than happy to share it with you. Just send me a message here, and I'll fire it off to you. Okay, guys, thanks so much. Talk to you soon.